Thanks so much for tuning in to this episode of Navigating Through Uncertainty. The underpinnings around economic growth and earnings growth for FY22 are as strong as they could have been, but it's a perfect cocktail of uncertainty. What with the rising COVID cases globally, rising yields, inflation, what have you, and the uncertainty around central bank action. And let's try and understand what all of this could lead to from an equity watcher's perspective or a market watcher's perspective across asset classes with none other than Ridham Desai. He joins us right now on the show. Ridham, so good having you. Thanks so much for joining in. I hope all is safe.
Yes, thank you, Neeraj. All is safe. Fingers crossed, and hope the same with you.
Likewise, Ridham. So maybe I don't think the central bank action is as unpredictable, but let's just first try and figure out how do you see things as they stand. I was looking at your report, which came in a few days back or 3-4 days back, which spoke about how growth going ahead looks very promising, but there is this intermittent scare currently of the rising cases and what it could do to derail the economic recovery that was just showing signs of taking off.
Absolutely, Neeraj. So, everybody knows COVID cases are back up and they've made a new high. I think in some parts of the country, I dare say the medical infrastructure is under strain, reminiscent of what we saw last year between June and September. While the case fatality rate has not risen as sharply, it does have a bit of a lag. So the metric I'm tracking is the 7-day moving average CFR with a 14-day lag, which the underlying assumption is it takes 14 days for an infection to unravel. It's a simplistic assumption, but that number has gone up by about 50 basis points. So it's gone from around 0.7% to 1.2. So, there is a threat, of course. And what we have learned from epidemiologists and virologists is that in some parts, this is a double mutant, like in Maharashtra. It has got ability to escape the immune system. It has got greater spikes, protein spikes, so it kind of transmits more easily. The virus is doing what it always does, which is its urge to survive. And we will have to act against it. So the risk is that certain parts of the country may go into short-term lockdowns or may have to impose restrictions, on activities. Like Maharashtra has already done a bit of that. And then we'll have to, as they say, break the chain to make sure that the transmission stops. So this essentially is a little bit negative for growth in the short run. If the things get out of control, then there would be some more risk to growth. If it spreads wider to greater parts of the country, then again there is risk. Now, nothing of what I'm saying isn't obvious, and it's so hard to forecast this virus. I know there are people making a forecast based on models, but as we have seen, these models have got limitations. They use the latest trailing data to make some forecasts, and really they are not reliable. So the market will react on a day-to-day basis, depending on how the virus unfolds. As we can see over the weekend, it's not been very pretty, and the market is reacting to it. Now, keeping this in mind, and assuming, and this is a very aggressive assumption, some may say, but assuming that the virus does not really cause crisis. And the reason for me to believe that it may not cause a crisis is because I think administration is better equipped than last year. We have some medicines available to stem the infection impact. There is a vaccination program that's going on, which will also temper some of the impact. So it is, I think, fair to say that it may not be as bad as it was last summer. Then I think this may just provide an opportunity for medium-term investors to buy stocks. So stocks, have been a little bit overdone for a while, and we've all been hoping that there would be some near-term correction, wondering what the trigger would be. The rise in the 10-year in the US really didn't provide that trigger. It proved, more short-term. Maybe this one does provide a little bit of a bigger trigger. The underlying thing is that the economy is actually entering into a new growth cycle. Policy, in fact, will be aided by this, ironically. So we've seen the RBI come and assert its dovish stance, surprising the market on the upside, saying we're here to take care of this and we won't back off until growth comes back, and in fact have a newly designed program to keep the 10-year under check. The government will launch more policies. We're seeing more production-linked incentives. That number has now totaled to about $15 billion, which is 50 basis points of GDP. So it's a pretty large transfer of public resources to the private sector. So clearly there is impetus on growth. This may provide an opportunity for investors to re-engage.
I was actually going to ask you this. You partly answered it. Some of the people that I speaking to, for example, Rakesh yesterday, and he's of course a Perma bull, but I'm just trying to draw your attention to the fact that some of the people that I've spoken to of late say that the people will look through the damage that the virus will cause for the next couple of months and not get unduly bothered. My only question to you, Ridham, is that when we were at 7,500, to discount what the virus will do and look ahead was probably easier because valuations were so much in your favor. At about 14 and a half, we may not be at all-time highs, but still at 14 and a half, we are no longer at the nadir of the valuations. So my question is, can this tactically, even though it may not be as large a correction as we saw in 2020, can it be a large enough correction, or do you reckon it will get bought into very, very quickly because of the sloshing liquidity?
See, Neeraj, that actually depends on other cumulative factors. So if other things start happening around this, then of course the correction can get deeper. I mean, I'll quickly remind viewers that bull markets can have 20% corrections. And in the 03-07 cycle, which was the last really big bull market we saw, we had a couple of corrections that went as deep as 25%. 25% is a lot, and markets can correct that. It's hard to actually make that call at the moment, because if it's only the virus that is the news flow, then I think this will get bought into more quickly. As I said, we are better equipped than we were last year to handle this, and I think administrations understand that we can do some quick fixes, like we are seeing in Mumbai right now. Now, of course, this may be early days and maybe famous last words, but the restriction on activities that were imposed last week seems to be now causing a kind of a flattening of the curve. It's still too early to judge that, but maybe another week of this, and the spread starts stemming. There is more evidence emerging that the biggest reason for the spread is human contact, and to the extent that we can remind people of masks and of social distancing, which I think people kind of forgot in February because everything had quietened down, and there's obviously a pent-up urge to interact. Then again, we should be okay. And in the meanwhile, hopefully the vaccination program, which by the way is now accelerating quite fast, reaches a new level in the next month or so. So these are the reasons why COVID on its own may not be enough. But if a few other things happen around this, if there's another wave of inflation threat, if the Western Hemisphere goes through another COVID wave, so a few other things happen around this, then obviously the correction could get deeper. Remember, the SPX is still at all-time highs, and if anything is still being bid. That's the backdrop under which we can't really correct that much. But if the SPX going to start falling for their reasons, then of course there will be a deeper correction. So I think for those who want to trade this market, I think they need to keep all these things in mind. Making these short-term forecasts is beyond my competence, actually.
No, you're being modest, but sorry, excuse me if I was requesting you to make a short-term forecast. I was just trying to understand whether you believe that there could be a larger correction or a smaller one. That's it. Ridham, sorry, you want to make a point?
Okay, Neeraj, if I may interrupt, actually, while the focus is a lot on the Nifty, I think what may happen is underneath, we may get a lot of rotation. Like we have got over the past couple of months, during which Nifty has really not made much headway. But underneath, we've got a lot of rotation and a lot of stuff that was underperforming earlier, like so-called factor value stocks and cyclicals did very well. And maybe some of that actually, gives up now. And people, in the interim, shift towards more defensive stocks, like you can see on the screen today. Underneath the Nifty, you could get a little bit more, bigger shifts. You could get bigger shifts than what the Nifty may suggest.
Okay. And I was going to come to that, because in your note also you mentioned that you cyclicals, etc., that you're bullish on, and SMID is something that you're probably bullish on, slightly medium term. But just before that, you mentioned the globe rhythm. Just quick thoughts here. Do you reckon that if the yields and the inflation, or the yields don't move from 1.7, 1.75 to say 2.25, 2.5 very quickly, but if they do it gradually, then do you reckon that global markets will take that well, and therefore that one push factor for the markets to correct lower might actually get diminished?
So, see, Neeraj, the global market is not one homogeneous place. Europe is doing its own thing. The US is on a different track, and emerging markets are doing different. So, let's talk only about the US here. I can't make the comment across the board. The US, in our view, is undergoing a lot of rotation. The US is likely opening up. And I think what the market is telling us, and this is the opinion of my US strategist, Mike Wilson, what the market is saying is that it may not be as smooth as we all want it to be, the opening up of the economy. It may cause a bit more heartburn. And therefore, there is a distinct shift away from small caps to large caps and back into the so-called quality stocks, which Mike apparently had already done in his recommended portfolio 2-3 weeks ago, in anticipation to how the market may trade ahead of opening up. So the US has got a slight lead over the rest of the world because it seems to have put its COVID peak. The vaccination program has achieved some momentum, and now it's heading into opening up. During this phase, he calls it the mid-cycle phase. We may actually go back to quality, away from cyclicals, and we may go back to large caps, away from small caps. So I think that's the nature of advice he provides to his investors. It's not like the market is peaking out and all hell is breaking loose and we are entering into a bear market and sell off. I think the underlying comment that Mike keeps saying is, I'm a committed bull. But within the context of a committed bull market, there are lots of things happening in the market, especially for those who have a shorter term horizon, and they need to trade those opportunities as they come along. So we are in that midst of one such opportunity in the US. So what could upset this? And clearly what could upset this is that if the threat of inflation emerges and the market starts believing that the Fed has fallen behind the curve. And that is, I think, still, and we discussed this in our previous interaction as well, remains, I think, the biggest overarching risk to this bull market that we are in the midst of. If that doesn't happen, then I think we should probably be okay. But if that happens, then I think there'll be greater disruption and it will flow to India as well. Now, on the India front, there are two things that we need to know. First is we have an RBI that's very committed at the long end. So despite all the supply of paper that the government is going to put into the market due to its higher fiscal deficit, the 10-year is very well behaved. The Indian 10-year bond has outperformed the US bond, even while the yields in the US have gone up, which is quite unusual. Usually Indian bond yields tend to rise faster when the yields are rising in the rest of in the US. The second is that we have an event out there, which is the potential inclusion of India into bond indices globally. So if that happens, it is billions of dollars of inflow. And if you notice in the bond market over the past few weeks, there has been a turn in sentiment from foreign investors, and they've been buying bonds, not last week, of course, but prior to that. And it could be some positioning ahead of this event. Now, these are technical factors that are favoring the 10-year in India. So the yield disruption in India has not been felt at all. But absolutely, if inflation risks emerge, then that is, I think, one thing that could disrupt the US bond bull market and then reverberate into the rest of the world.
What about the inflation factors within India as well? I mean, everybody talks about these rising commodity prices being one. And if we look around as well, even though the RBI may be committed to them, we've had instances of two or three central banks, and please correct me if I'm wrong, but in the Asia Pacific and the emerging markets, are sounding a lot more hawkish than what they would have sounded 3 months ago. Could something happen that could force the RBI's hand, or do you think the central bank is comfortable enough to navigate through this with its current
See, yeah, so internally, I think we need the growth cycle back. And if the growth cycle comes back faster, then of course the RBI will step up away. Because I think it seems like the RBI is very committed to the growth cycle. I don't expect sustained inflation pressures when growth is weak. The other thing is, of course, what happens externally. And if you get a big rise in commodity prices, then of course this will change the RBI's view. That supply side inflation would be a big risk, which is what we just discussed. And it will obviously cause a dent into India's growth story, because then you have to lift interest rates even while growth is not at potential, and depress the growth rate in order to counter the rise in supply side inflation. So these are the obvious things that may hamper the RBI. For now, they are not things that are in play. And so the RBI, I think, is willing to say, I'm committed to get growth back. And I'm committed to keep the 10-year in check.
You had made this point, Ridham, sometime back about the nature of the earnings composition in India, and how a lot of it would be commodity price agnostic, so to say, but some of it would be majorly impacted. We've had SIAM, for example, make some comments today, in addition to the commodity pressures that they're seeing, about how there is a major down cycle of sorts that the industry seems to be in. How do you dissect that pressure, commodity price inflation that has happened thus far, and even if it remains at these levels, what it could do to an earnings scenario, which was actually looking like a Goldilocks scenario maybe a couple of months ago?
See, top down, it has less of an impact because some sectors face raw material cost increases, and there are other sectors that benefit from that. So, big picture, it kind of neutralizes, and the margin compression is not as much. But at the individual sector level, there could be a temporary margin disruption. While companies are still gaining from higher demand and higher operating leverage, but have to overcome the cost push. Ultimately, as the cycle progresses, companies gain pricing power, and we call that as inflation. And that's what basically causes the rates to go up and ultimately for growth to slow down. So that's how the typical cycle happens. We're still very early days in this. And therefore, I think there'll be a few intersector margin impact that may come through, and some of it may already be priced in. I think the market is forward looking and may have already detected this, say, in the auto sector. And it'll fade away after a while. But again, it goes back to our conversation a few moments ago, which is the biggest risk is that this sustains, and the market globally starts believing that we are in for a cost push inflation arising from stronger than expected demand, which means the Fed has fallen behind the curve, and then of course PE multiples fall, and things get a bit harrowing for equity investors.
Yeah, the bull on the tech side believes, Ridham, that even if rates move up and P multiples for tech companies globally fall, Indian tech is slightly disconnected from there because of the nature of the business and earnings growth looking so robust there. What are your thoughts here?
Yeah, so I have to admit this is a poor call that I've made. Tech stocks have done, tech companies, I should say first, have done significantly better than what I thought, and they seem to be continuing to deliver performance. There seems to be a structural undertone to their earnings progression. The call that I have in my head is one that is relative, which is if India's growth cycle is coming back, then the steady growth that tech companies are likely to deliver will underperform the cyclical uplift that will happen to earnings to domestic sectors. So we are still hanging in with that call that we want to be over domestic sectors versus tech, because the relative earnings growth will favor domestic sectors. The risk factor is that domestic growth does not come back for all the reasons that we've already discussed. And then, of course, tech stocks continue to perform well. And you can see that when the market is going through a sharper correction, technology outperforms. And this is exactly the reason, because the relative growth shifts in favor of tech companies. But I have to say that tech companies have done very well and seem to be set for a better medium-term growth outlook than what seemed to be the case, say, 2 or 3 years ago.
Ridham, in that same breath, can I ask you if you are looking forward to the string of pure tech companies, tech platforms that are gonna get listed in India? Is that something that excites you at all?
Absolutely, Neeraj. The one of the conversations that we've been having with with institutional investors over the past few months is the lack of new listings in India, new business model listings in India. That India has really not had any new business model list, the type of stuff that we saw in China, say, 10 years ago. What investors don't appreciate is that India is more than 10 years behind China, and is at 1/6 the per capita GDP of China. So China is at a different level, and at that per capita GDP has got newer business models that emerge. Nevertheless, India has also actually done quite well in this regard. And yeah, there is a big pipeline of such listings that are happening, hopefully in India. Some of them will probably list in the US, but they will be India-related businesses that are listing with private equity investors looking for an exit in some cases, and in other cases where these companies are trying to raise capital for their next growth path. So it does look very exciting. I have to say that, if I quote Nandan Nilekani here, India's internet sector has progressed a little differently from the US and from China. Because of the Aadhaar superstructure, we have a transaction-based internet economy, where I think internet companies are going to be able to realize earnings very differently from what we've said. Now, if I make a sweeping statement, for example, US e-commerce businesses or tech companies are largely advertising models, whereas in India, I think they are largely transaction-oriented. So it looks very interesting. There are some very exciting businesses out there which hopefully get listed and will give more choices to investors over the course of the next few months.
Okay. Ridham, a couple of other factors that you pointed out. I'm shifting gears towards macro yet again. What about factors like oil prices, for example, as you see them, or the dollar versus the rupee, and then the DXY strength that is just starting to come back a little bit in the last couple of odd weeks? How do those factors play out, and what?
So DXY is the indicator which tells us what the world is thinking about inflation, right, and interest rates. So the DXY remains a very important metric for people to track, and if it is appreciating, that's not good news. If it's depreciating, it's good news for India. India tends to do very well when the DXY is depreciating. I'm not going to go into all the mechanics, but the simple thing is it allows room for policymakers at home to drive a domestic policy. We're not then anchored to what happens globally, and therefore we have greater flexibility in choices we make. For example, if the DXY is depreciating, the RBI can comfortably keep rates low and drive for higher growth. The point on oil, which I said.
Sorry, just before that. But while it was depreciating, we've seen a bit of a spurt in the DXY. So, what's your thesis about how does it play out going ahead? There's a lot of debate around what the DXY, consequently, what the rupee would do.
Yeah. So I mean, you're asking me what the DXY is going to do?
If you have thoughts there.
I don't have very strong thoughts around that.
Okay.
And it's not a strong view that we hold globally, either way. It's premised on the US growth cycle and the inflation outlook in America. So come 2022, I think things will get trickier. because inflation will be a little bit of a bigger problem. And then I think this may feed into a bid on the US dollar.
Okay.
I think during the current calendar year, we should be fine. Um, on your question on oil, as I've said in the past, oil matters to India when it is rising relative to copper prices. And the reason I say this is because uh, it should be a supply driven event in oil for India to suffer in macro terms. See, oil and copper both go up when global demand is strong, both being intrinsic commodities to the industrial economies for the world. But if oil is also facing additional supply side pressures, then it will tend to outperform copper.
Hmm.
And for India's BOP or for India's macro stability, what matters is that because when oil and copper are both going up, India is also receiving very strong inflows. The BOP actually tends to be in good shape, as we are seeing right now. So oil is not outperforming copper, and therefore a rise in oil prices is not automatically bad for India. And that's the framework to follow. So that's how we judge the impact of oil on both the stock markets as well as macro stability.
And currently, it's not a worry, as you said. Okay. One final question, Rhythm, and that is on relative valuations. You've always spoken about both within the index, large cap versus mid caps relative valuations, and then India versus EM's relative valuations. You make that point in your report as well. How does that metric stack up for India vis-a-vis rest of the emerging market pack?
So India remains at the low end of its historical range. Essentially, what markets are saying on a relative basis, India is unlikely to go back to its premium return on equity that it earned over the past 20 years. And the template is going to be more like the last 5-7 years when the ROE gap has been contracting. It has gone down to about 200 basis points. That is India's ROE minus EM ROE. Used to be 500. Now, if it goes back to 500, then India should regain some of its valuation premium that it has lost over the last 5-7 years. I dare say that the ROE premium will rise in the coming months. I think India's growth cycle seems better placed than the EM world, and therefore India's relative valuation to EM should also rise. So India may have put a trough on relative performance versus EM back in April last year. Since then, it has tended to outperform more than underperform, but it's not a straight line up. There's still a lot of doubt out there about India's ability to deliver a sustained rising ROE, and only the coming months will show that. Just quickly on valuations, Neeraj, while we're on that point, it's not all so rosy when you look at absolute valuations. A lot of these metrics have risen considerably over the past 12 months. And clearly, the market is a forward-looking animal. So it is anticipating better growth and goes back all the way to the starting point of our conversation that if something out there happens to challenge that growth view, then some of these valuation metrics will have to undergo a steeper than a tactical correction. So keep a watch on that because, as you very rightly said, we are no longer at 1.9 times book. As we were in the spring of last year. We're more in the 3.5 region. And the tolerance to a negative growth shock will not be as good as it was then. Not that we're expecting a big negative growth shock, but we have to keep that in mind.
You or have you in your FY22 estimates assumed a very rosy picture, and do you reckon that a month or two of lockdowns, which may not be as severe as they were back then, because I was speaking to companies and they said maybe manufacturing in select periods could be allowed. So if the lockdowns are not as stringent, do you reckon a risk, your assumptions, if they were indeed very optimistic, or have you not been very optimistic when you look at FY22?
No, so we are not assuming in our estimates that there will be a 1 month or a 2 month lockdown. Okay.
Of course.
So if we get into a situation where, say, 5 large states have to go through a 1 month lockdown, then there will be a little bit of a trimming of estimates that will happen. So it has to be a bit extended and it has to be a little bit more widespread. Maharashtra doing a 2-week lockdown may not have such a big impact because what will take place is that, yes, of course, there will be a little bit basis points of growth that goes away. Immediately after the lockdown is opened up, then the pent up demand comes right back, as we have seen from last year. There's very little permanent loss of demand that happens, except for certain services which you can't recoup. So some sectors will suffer, but it won't have a top-down impact on the economy. However, if it starts spreading and then a few more states, especially the larger ones with bigger economic activity, start seeing that impact and need to then lock down to so-called break the chain, then I think we'll probably have to reevaluate. We've not done that as yet because we're not expecting that. I don't think the market also is expecting that. So then the market also, going back to your point, will have to actually go through a slightly more extended correction.
Okay. Ridham, thank you so much for explaining some of the parameters so lucidly. Really appreciate your time and stay safe.
Thank you, Neeraj.
Okay. And viewers, thanks for tuning into this edition of Navigating Through Uncertainties.